Bill Harbin International specializes in design, build, and general contracting for national and international clients representing construction markets of every classification. Our tagline is, "We build anything, anywhere."
Keeping up with an equipment fleet and tool management can take the focus away from running your manufacturing operation. Work with Amico to save time and money on equipment rentals, fleet management, and tools. Letting you focus on your core business is our core business.
Welcome back, everyone, to the South Carolina Manufacturing Conference and Expo right here on SC Biz TV. In case you missed our prior session, Industry 4.0 Trending Topics, it is now archived on SC Biz TV, and you can watch it whenever you wish and as often as you'd like. This is our last session of the day. The day went quick. Kevin Roberts, the Global Automation Senior Analyst for Ernst Young, will present the economic outlook for the auto industry. This session is presented by Burr, Forman, McNair. They are a century-old full-service law firm located in Greenville. They service numerous industry and practice areas ranging from commercial litigation to corporate transactions. We'll pause for a short message from our presenting sponsor, and then Kevin Roberts with Ernst Young will present the economic outlook for South Carolina's auto industry. See you back here shortly.
Hi, my name is Jim Gillum, and I'm a partner at the law firm of Burr, Forman, McNair. Our firm is proud to partner with the South Carolina Manufacturing Conference and sponsor the Automotive Outlook this year. In such a critical year for the automotive industry, we appreciate this opportunity to help bring these insights and industry updates to this year's virtual conference. For over 100 years, our firm has represented manufacturers across the Southeast. In particular, over our long history, we've represented some of the largest automotive manufacturers and suppliers in the United States. Our team has helped major automotive manufacturers expand their operations, as well as helped numerous Tier 1 and Tier 2 suppliers and dealerships across the United States. Our automotive legal team at Burr works with clients on a full range of legal services, including site selection, tax incentives, construction, labor and employment, supply chain, environmental, mergers and acquisition, and litigation. With 19 offices across 8 states, our team at Burr, Forman, McNair is able to serve clients in the industry with local, national, and international legal needs. Again, we're excited to be a part of the 2020 virtual conference and look forward to hearing from the speakers today.
Hi, this is Kevin Roberts, Senior Mobility Analyst with EY. Coming to you live from my home in the Motor City of Detroit, Michigan. Unfortunately, couldn't be with you in Charleston this year, but really happy to be with you virtually to be talking about the economic outlook for the automotive industry and where do we kind of see things moving from this kind of post-COVID environment we're in now. What have we seen happen and where do we see the industry evolving? So, going to spend the next 30 or so minutes giving you a quick update of where we see the industry going. So with that said, I think we can dive into where we currently see the automotive industry in its current state. So what is going on within the automotive industry? Well, it's been an interesting time to say the least. So since we're doing an economic outlook and my background is in economics, I thought we would start with some great economic data. So using some economic forecasts here, we can see, obviously we're seeing a massive contraction with regards to real GDP. What's really interesting is that this contraction is looking to be more severe on an overall global level than what we saw during the Great Recession or the financial crisis around 2008, 2009. And the issue being that when we're seeing a contraction now, it's impacting almost all markets across the globe. During the Great Recession, it tended to be a more localized pullback. And so we didn't, while it was still a pretty painful contraction, especially where you were within the world, we're now expected to see a little bit more of an aggressive decline on an overall global level. The interesting thing is, though, that while it's been a relatively painful contraction from an economic point of view, from a shareholder point of view, if you look at the global share price index on the right, it's actually up and continues to go up in 2020 so far. So kind of contrary to what we saw, or is somewhat different than what we saw during the Great Recession, where obviously we saw economic contraction followed by share price contraction. We're not seeing a similar type share price contraction so far. Taking a look at this from a purely U.S. point of view, again, like I said before, it is a highly regionalized recession in 08, 09. So from that point of view, we're seeing relatively the exact same type of experience that we saw at that point take place in the U.S., rather severe drop in real GDP. And then we're also seeing a high increase in unemployment rate, which again is not unexpected at this point. So that's what we're kind of seeing at a high level from the economic side of things. So what does this mean for the automotive side? Well, COVID has not surprisingly had a massive impact on vehicle sales. So last year we had around 90 million vehicles sold globally across the world. That's expected to decline to around 75 million vehicles this year. So glass half full, that it is an increase of where we were just a couple months ago, where the expectation was it was going to be a much more aggressive contraction. Glass half empty, while we do see some recovery in 2021, we're not expected to see, a bounce back right to 2019 volumes right away. And it's likely going to take several years before we kind of recover that lost volume right away. So taking a look one layer kind of below the global level, and some good kind of stories here is that while, the contraction that we saw was at this point, barring a secondary wave of shutdown, seems to be really kind of hyper localized around the March, April, May timeframe. You can see from an overall global SAR, so seasonally adjusted annual rate, that most of the pain point really seemed to be around the April time. And that since that time, we've seen an increase in overall global SAR from that point of view. Again, similar to what I mentioned before, which is localized economic conditions. Similar automotive, most markets globally have seen contractions this year, but you can see on the chart on the right, a little bit of a spaghetti here, but you can see that not all markets saw that kind of shutdown at the same time. So while some markets saw their pain points in February, others saw them in March, April, and others are still kind of working through them right now. So while we're seeing the consistent global kind of pain across the board, it's not kind of equally shared. And so we're starting to see some markets actually perform quite well, while others are still struggling on that side. So that's when we looked at from the sales side. So we look at things from an overall production side. You can see that the narrative is similar, but a little bit different. So one, we can see that overall production is expected to decline in 2020 again and bounce back slightly in 2021. Now, what I'll call you to is that when we looked at the sales volumes, there was around 90 million vehicles sold in 2020 or 2019. We had about 88.8 million vehicles built at that time. The expectation was we're going to build around 90.4 million vehicles pre-COVID forecast. That's dropped down to 73.9 million units now. And the real concern there is that kind of gap between sales and production. If you look at the chart on the right, we're looking at average plant shutdown weeks. So the number of average weeks we saw plants shut down during this time frame. And some of these shutdowns were quite lengthy. 6, 8, 10, 12 weeks long shutdowns. And it's going to be very, very difficult on the whole for the industry to kind of recoup that volume in any kind of easy manner. So in some ways, those kind of lost weeks of production are relatively gone from a certain point of view. And it's going to be very, very difficult to kind of recoup that overall volume from that point. So when we take a look at how that production has kind of shifted across the board, it's primarily focused in Asia Pacific region, North America and West Europe. Not surprisingly, that tends to be where a lot of our vehicles tend to be built. But you can see that Asia Pacific region seems to have the largest rough declines there. Although interestingly, China isn't expected to be as significant of a decline there than what we have seen in the past, followed by North America, Western Europe, and then our smaller regions obviously have less of an overall decline there, but you can see it's pretty significant across the board, with each market showing some sort of contraction from overall global production. So, getting back to what I was saying before, which is, a lot of lost volume is out there and it's going to be difficult to get that back. If we look at production losses, they may have peaked in April, and they're starting to come back online now. But I mean, that's still a large amount of volume that was lost. It's going to be exceedingly difficult for the industry to kind of bounce back in any kind of quick manner to kind of recoup that volume. So you can see, January was down slightly, 12%. It started to pick up in February and March, down 20 or 33%. And then April and May really were from an overall global point of view, the most painful months there was 61 and 51% contraction. June bounced back, and you can see that once we kind of reach July, the numbers are, plus or minus within, I would say, a relatively tight band from where we were, pre kind of COVID shutdown. So definite improvement there, but you can see we're not seeing any kind of large increases in production of, plus 10, plus 20, plus 30% or anything like that to kind of counteract those rather large declines that we saw in March, April, and May. So again, this kind of gets into a difficult, level of, supply chains and trying to balance everything out from that point of view. And we'll look at how capacity utilization looks like going forward. So it's not an issue of capacity utilization. We have the capacity to build a lot more vehicles. It's just kind of a multi-layered approach that's kind of holding us back from kind of reaching that point of view. So I kind of hinted at utilization. And so what we've seen across the board is a major drop in utilization. So when we look at the automotive industry, for the most part, 70% utilization is considered break even, 80% is considered ideal, 90+% is really where you want to be from a utilization point of view to really focus on that profitability. When we look at things from a regional point of view, we don't see any regions remotely close to those types of utilization numbers. North America looks to be the best, hanging around the mid, kind of low to mid 60% utilization range in 2020. Europe getting close to 55%, and then the other major region we were talking about, Asia Pacific, there is below 50% utilization, and South America and Middle East are even lower. So what we're seeing is not only do we have a reduction in the number of vehicles being produced, and we've bounced back to 2019 levels, but we're not increasing beyond them. So what that's really doing is really pulling down the overall utilization on a global level. And so we have a lot of plants that are running on limited capacity from where they could and should be. And so that's a major trend that we want to keep an eye on as we continue to move in and out of this kind of recessionary environment. But how quickly can we get these plants back up and running and kind of getting more production out of them? So we're kind of looking at everything from a kind of global point of view. Wanted to give an idea of how the auto industry is looking from an overall kind of view. The U.S.'s context within it, but let's kind of dive down now into where the U.S. Economy looks like from an automotive side. So good news, bad news. Obviously, we saw a massive contraction in vehicle sales from a SAR point of view, very similar to what we saw during the Great Recession. You can see we went down to levels just like what we saw in 2009. But interestingly, that demand has remained significantly stronger than I think anyone really expected, kind of going into the COVID shutdowns in March and April. We did see a massive pullback in vehicle sales, but you can see they've shot relatively quickly back up. When we look at the 2009 numbers, it was more of kind of a steady decline there. And outside for that spike in 2009, which is cash for clunkers, which kind of shot SAR up for 1 month, and then went back down and had a pretty steady, slow increase from that point onward. It's been a pretty quick kind of turnaround with regards to vehicle sales so far. So demand has remained significantly stronger than I think anyone kind of expected. Especially the stimulus payments that went out seem to really kind of help to kind of spur vehicle sales from that point of view. And there's also a thought that with people traveling less, it reduced overall costs, which may have kind of opened up more funds for vehicle purchases. And then again, there was a lot of great financing offers out there that really kind of helped increase sales as well. When we look at production from a North American point of view, and so we don't want to look at production just from a U.S. point of view, as we have so many vehicles built for the U.S. market coming from Canada and Mexico as well. We can see that April was definitely our low point. We almost had a 100% contraction of vehicles produced in April. May was very close to being just as significant of a contraction, but we bounced back up in June, and you can see we're roughly in line with what we saw at the global level from July onward, which is we're seeing some positive increases from year over year, but there isn't, as much as possible to really kind of recover that production volume that we lost in March, April, May. If we add that up, that's several million units of vehicle production lost. That is going to be, just very, very difficult to come back. And we're starting to see that impact show up with regards to inventory. So when we look at inventory for the U.S., similar to Great Recession, again, we saw a decline in inventory as automotive plants pulled back. This time they were shut down due to COVID, less so due to kind of demand point issues. But what really the interesting thing that happened is that we're in a real kind of quandary right now, which is demand, which declined in line with production during the Great Recession and stayed roughly in line and then increased in line. Now, as we saw just a couple slides ago, demand's actually kind of bounced back relatively quickly, at least kind of that retail consumer demand. Fleet demand is definitely going to be remain depressed for expected longer time period. But that retail demand has really bounced back quite quickly. And so what we're seeing now is the issue is less of, is there demand from consumers to buy the vehicles? Do we have the vehicles that people actually want? Granted, we still have a large number of vehicles sitting out on dealer lots right now, roughly 2.5 million or more vehicles sitting out on dealer lots across the country in the U.S. But that is down from around 4 million units where we were just a year or so ago around this time. So loss of about 1.5 million vehicles, starting to impact consumers' choices when they get out into the overall market. We're starting to see some kind of rough changes there as well. So what's happened to used vehicles? We've been talking about a lot about new vehicles, which always kind of remain a focus. Used vehicle market's been really, really interesting as well. Similarly to what we saw in new vehicle market, rather sharp contraction, around the April time period. There was a lot of concern about what demand for vehicles would look like across the board, especially used vehicles as well. And we saw massive declines with regards to, the value of used vehicles. And then very similar to what we saw with new vehicles, that shift bounced back exceedingly quickly, you can see, and has actually gone above where we were before. So the thought went from, the sky is falling with regards to used vehicle values to now it's bounced back and is actually above, in some cases significantly above where we were at the beginning of 2019. And so we've seen that happen not just in the vehicle price indexes and value indexes that we follow, but with regard to the the overall used vehicle price level as well has shot up significantly. So kind of counterintuitively to what a lot of us thought in March and April, where we were expecting a kind of lengthy kind of decline with regards to vehicle demand that would negatively impact used vehicles values. We've seen it have significantly more strength and robustness than I think anyone really expected, and has shot up quite significantly there. So again, another, I guess you could say, relatively positive story coming out of COVID, which is the price stability with regards to used vehicles. So another trend that we've kind of been seeing is, over a long period of time, is the average transaction price of vehicles has been continually going up. So if we look at average transaction price from 2018, 2019, 2020, you can see there's been some pretty steady, consistent increases there. We've seen that kind of flatten out in the COVID environment. Kind of eventually it spiked in April, and so what we saw there was a lot of consumers were taking advantage of those 0% financing offers to kind of get rather large, expensive vehicles with lengthy 0% financing terms. So that actually shot the average transaction price up before kind of plateaued out. So average transaction price still remains higher than what it was in 2019. In some ways, we thought it might go down as people maybe changed their vehicle preference and shifted more towards more price-effective vehicles, but that has not happened so far. The average transaction price continues to remain relatively high. And I mentioned incentives, and you can see that on the chart on the right. So the average incentive price goes all the vehicles sold in the U.S. So incentives have been high for a long time, and you can see that roughly early 2020, especially January and February, were roughly in line with what we saw back in 2019. And then you can see those numbers really start to accelerate April and May timeframe. And that was when there was really the most severe concerns about what demand would look like from consumers for new vehicle at that point. So we saw a massive increase with regard to the average incentive available out there for new vehicle purchases. And then, as we saw before, that demand kept creeping up. And so what we've seen is a relative give back with regards to incentives from that level, and they've been back down to roughly 2019 levels again if we look at the September number. So, kind of eventually that demand within the market's been there, coupled with the I guess you could say, relative lack, at least with certain vehicles, of availability out on dealer lots, has really allowed OEMs to not completely pull back, but I guess you could say pull back to more 2019 levels of incentive spend, which has definitely been a positive for the market on that side. So we've been talking a lot about just kind of the raw stats within the vehicle market. So what have global sales and production look like? What have we seen from kind of U.S. sales production, kind of rough kind of trends there? The next thing I want to mention was, depending on how you view the situation that we're in right now, there's a thought that this could actually be a positive for vehicle sales. And this has to do with the fact that there's a focus now, I guess you could say, on safety, security, limiting exposure. And that could actually be a boon for private vehicle sales, and that there could be a decline in the use and desirability of shared mobility, which had been a focus over the last couple of years. And so, again, it's unknown if this will have a short-term impact, long-term impact, but there is a case to be presented that potentially this could be a positive for the new vehicle industry. So, if we look at it from a U.S. point of view, and I'm just using U.S. stats here because we're talking to a U.S. crowd, and these are some of the more kind of interesting, easier ones to get to, is that, the population not staying home. So again, these are roughly, you could say, the population that's been going out. So pretty consistently, if we average together kind of the daily rate, everything has been around 80%, pre COVID, and you can see those numbers dropped in the COVID environment, but they didn't drop significantly, right? So there's still a lot of mobility taking place and people moving about, even when we were in the most kind of severe kind of lockdowns. And you can see that based on the vehicle miles traveled data. So this is the data from the Federal Highway Administration looking at where do we see vehicle miles being traveled on a monthly basis. You see, January, February, roughly in line, slight increase of where we were in 2019. And then as time kind of moves on, March, April, and May, kind of the peak of the shutdown times there. Now you can see the vehicle miles traveled drops significantly, 19%, 40%, 26%, but it's not a 100% drop, right? So there was still a decent amount of vehicle miles being traveled within that time period. And then we've seen some comeback in June, July. So kind of interestingly, I think, from a certain point of view, I thought that we had more kind of severe kind of shutdowns with regards to mobility during our shutdown time frame, but we haven't quite seen that. Where we have seen some significant shifts take place is how people are traveling within that. So if we look at the overall vehicle miles traveled, we saw that it went down, it's coming back. It's still not where it was previously, and it could take some time to get there. But when we look at things from an overall point of view, and this is just some New York City data here because it's readily available, and I think is a good proxy, just kind of showing what's happened overall. So the chart on the left is showing you trips per day by license type. So we have FHV, high volumes. Those tend to be your ride-hailing services, and then we have our yellow cab and other cabs. And you can see massive contraction in the March, April, May timeframe again, which is where we saw the major kind of shutdown there. The interesting thing is that we have not seen those kind of shared mobility demand services bounce back nearly as significantly as we've seen with private vehicle sales or used vehicle prices and demand and things like that. So we've seen a relative flattening and slight bounce back with regards to shared mobility with regards to vehicles. And then if we look at it from MTAs to different riderships, from different subways, buses, things like that, you can see significant, contraction again in that, late March, April, May time period. And we've seen it come back, but it's still nowhere near what it was previously. So again, this is definitely a trend we're keeping an eye on. Not sure what the, kind of permanent long-term trend with this is going to be, but definitely something that we think could potentially be an interesting trend to keep an eye on. And could this be an actual positive for new vehicle sales kind of moving forward? So spent a lot of time now kind of going through where we see the industry now and how we see it evolving. So wanted to come back so you can see my face again for just a quick second. Say we're going to shift now from talking about where we kind of see the industry currently sitting at to where do we see the outlook kind of looking at for the overall industry here. So taking an outlook of where we see the industry evolving over the next several years here. So similar to what we did before, we'll talk about an economic point of view first, and then we'll kind of dive into where we see the industry kind of trends going. So from an overall GDP point of view, from a global level, the expectation is that we should see significant bounce back from a percentage variance. If you look at a raw variance, it's not going to be quite the same, but a significant percentage variance back up in 2021, and then consistent overall global GDP growth after that. So at this point, I think everyone's kind of baking in the expectation of a no double dip recession at this point, and continued GDP growth from that point forward. And then if we look at the industrial production index here, industrial production, not surprisingly, from everything we just seen from an automotive side, from an overall industrial production side, expected to contract in 2021, but should be back from an overall index point of view to where we were in 2019 and 2021 and continue to move forward from that point. So real positive from that side. If we look at things from a U.S. side, similar type story, where we're expecting to see significant real GDP contraction in 2020, and a positive increase, again, not looking at a relative point of view, but a percentage increase in 2021 before continued GDP growth from that point forward. And again, if we look at the unemployment rate, we've seen that spike in 2020. Expectation is that's going to continue to mitigate down over the years as we continue to move forward. So not a complete bounce back from the point of view of unemployment, where we see it go right back to 2019 levels in 2021. But definitely, roughly, I would say a positive story on that front. It's not at this point expected to be a long economic slowdown like we may have saw during the Great Recession. So moving on, we're expecting overall vehicle sales to continue to increase. I mentioned before 2021 wasn't expected to bounce back immediately to 2019 levels. You can see that it takes till around about 2023 till we kind of surpass those 2019 levels. But the long-term forecast still for the industry is to pass 100 million vehicles. We've been getting close to it for a while and then kind of pulling back. So the expectation is still that the industry is going to kind of crest that 100 million mark in the coming decade and continue to increase there. Now, where that growth is coming from is going to be interesting, is that a lot of that growth is forecasted to come from emerging markets. So you can see in the donut chart on the right that Asia Pacific, East Europe, Middle East, South America are really expected to be the large drivers of that vehicle volume growth that we're looking there. In more mature markets like Western Europe and North America, you can see are relatively small slivers from that point of view. So while still a lot of growth is forecasted for the overall automotive industry, where that growth is coming from is going to be shifting. While over the last decade we saw kind of a more kind of even mix between emerging and mature markets, we're not expecting to see that kind of mix going forward. So taking a look at production, excess capacity, and utilization that I highlighted before. So 2020 is expected to be the rough low point from this point. And you can see that we are expected to see sequential assembly production gains as we move throughout the forecast window in line to meet those rising sales figures that we were just looking at. However, you can see that there's still going to remain a large amount of excess capacity sitting out in the market. So this is the lowest we've ever seen utilization go low from an overall global point of view. And even by the end of our production forecast time period of 2027, you see utilization still only expected to be around 68%. So, definite something to keep an eye on if you're looking at this is what is the capacity utilization? What does our excess capacity look like? It just seems like we have way too much capacity sitting out there. And so we're either going to need to potentially look to increase vehicle production to help mitigate that, or is there a need for reduction in capacity? These are decisions and things that we need to keep an eye on as we come out of this downturn here. So one thing I haven't mentioned so far is actually been taking a look at powertrains. So this is a powertrain forecast looking at just what the alternative powertrains are. So non-internal combustion engines. So this is everything from mild hybrids, full hybrids, extended range electric vehicles, fuel cells, plug-in hybrids, and battery electric vehicles. So on an overall global basis, the expectation is that by the time we reach out to the 2032 time period, roughly 53% of all powertrains sold globally will be in some form of alternative powertrain. So just 47%, legacy internal combustion engines, at least 53% kind of those alternative powertrains. And you can see by 2032, the expectation is that battery electric vehicles will become the largest version of that, followed by 48 volt mild hybrids. So just kind of wanted to highlight on this. It's normally a major trend that we're kind of seeing from the overall industry. Focus has kind of moved off of CASE, connected, autonomous, shared, electric, as we've been kind of coming out of this COVID type environment, but just kind of keeping at least a light eye on that, how we see that evolving over time there as well. And then finally, just kind of want to talk about the outlook for the U.S. as well, since we spent a lot of time talking about kind of the unique trends that we're seeing from the U.S. industry. So overall, from the U.S. light vehicle sales, outlook, again, 2021, you can see we're expected to see some comeback before we kind of reach the mid-20s, which tends to be somewhat of a plateau there. But you can see we're not expected to see those volumes shoot significantly above where we were in 2019. As discussed previously, the mature markets are expected to be relatively flat to declining markets as we move forward. So you can see that with regards to the sales forecast there. Again, I know I keep saying glass half full, glass half empty. I guess that's just kind of the term how you're looking at this data at this point. Glass half full, we're looking to plateau out what would be historically high market. And so a lot of those sales years that we're forecasting coming forward will be top 10 sales years ever for the U.S. So that's an absolutely great place to be. Glass half empty, we just don't see that upside in the market that we're seeing in emerging markets for additional vehicle demand there. And then kind of looking at where we see vehicle assembly utilization, similar to what we saw at a global level. The North American environment does look better. We see much higher utilization levels than what we're seeing at the global level, but still a large amount of excess capacity there. So similar type narrative there. So with that, our time has come to an end. Want to thank everyone for kind of sitting with me while we went through this story about how we see the economic outlook for the auto industry. So again, been a real pleasure talking with you. Hope that we can be together in person in Charleston next year. So thanks again.
Welcome back, folks. That was Kevin Roberts with Ernst Young presenting the economic outlook for the auto industry. Well, that does it. Day one of the South Carolina Manufacturing Conference and Expo is complete. But day two is still to come. Tomorrow we'll discuss the connected industrial workplace of tomorrow and building a next generation workforce. Other events tomorrow include the presentation of the South Carolina Logistics Economic Impact Study, Women in Manufacturing, Leaders and Influencers, and the anchor event, the 23rd Annual Manufacturing Excellence Awards. Also, South Carolina Secretary of Commerce Bobby Hitt and the state's governor, Henry McMaster, will deliver presentations. All of today's sessions are now archived right here on SC Biz TV. We'll see you tomorrow for day two of the South Carolina Manufacturing Conference and Expo, the most significant manufacturing event of the year.